All right, today started on the right foot. Things were looking really, really good. We got the CPI report. It wasn't very strong, came in below expectations. The next CPI report should even be better. That's kind of a lot of the chatter was about. The market took off. We had a really, really good gap to the upside, more than 1% gain on the markets to the upside. We were looking set for a nice, strong runaway gap, upside move. Where we get a gap, we don't fill it in, we just take off, we get a good strong gain, and we start that. Remember, we start that big, 5%, that explosive 5% move or more to the upside. If it ends up being more, that first 5% ends up being very explosive, very fast. And so it looked like today might be day one of that. And I've told you before that a lot of those gains tend to occur overnight. Well, again, we got the good gap, we were set up for that. Didn't work out that way by the end of the day. So ended up being kind of a nothing burger of a day. It wasn't, it wasn't part of an explosive rally, but at least we didn't build on the losses either. Unless you're the Dow Jones Industrial Average. It didn't build on the losses either. The Dow getting a second cluster in a row where most of those major averages got the clusters here last week. So improvement in short-term sentiment. We'll talk about how all the other asset classes performed, how the sectors perform, because that's a big deal. There's a specific sector we want to do well if we are going to rally, and it did well. So we'll break that down. We'll talk about how rates are moving, because that's an important determinant right now, with especially the Fed rate cuts coming up. Remember, the more bullish we are, the less we want the Fed to cut rates. So right now, where there's 100% odds practically of cutting rates in June, we want those to come back down to zero as much as we can if we want to be bullish through June into the end of the year. We'll break all that down as well as give you our trade idea at the end of the day, end of the video. So let's go ahead and get started. Today is Wednesday, March the 12th, 2025. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website on MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, check out some of these other things over here on the right, including our Market Outlook live videos, where I take a look at old Market Outlook trades, see whether we should stay in them or get out of them. Especially with the bigger bounce that we had today, and a lot of these stocks, we talk about whether we should close them and how to hedge them. We've been talking about that the last couple of days. Anticipating a day like today, we've been talking about that the last couple of days. And then we also put on today's trade already before the market close. Come down to the bottom, click this heart, it opens up this tab. Click that like button, same thing here. Click the thumbs up icon, it opens up this tab. I hit that like button there. Again, the more you do that, it helps get our content out to all of our followers on these platforms. So thank you to those who do this day in, day out. Those who don't, you can do it right now while you're watching. We can try to be almost got the 50. That's the goal, right? Is to get to 50. So thank you again, and thank you to those who will do it here tonight. All right, let's start off taking a look at the S&P 500 with the market forecast indicators. You can see we had a little bit of a bump higher today, up 0.5%. Wasn't as good. We started off up more than 1% on the opening gap. We're looking really good, looking like we could get, and I'll talk more about this here later, like we get a runaway gap, but didn't happen. We actually filled in the gap this morning and then some before rallying and then falling back down, staying within the range that we set early and finishing, like I said, with 0.5% gain is all that we had. So short-term sentiment rallied, but again, it's not very high. Remember, we need to cross 40 on the near-term line, and we're just not close to it. The momentum line's also pretty low, so neither one of them are really giving us strong indications that this is the low point. At least not yet, right? Because usually when you get the low point, we go from below 40 to above 80 really quickly. And ideally, we cross above 40 and either 50 and 60 at the same time. That's kind of how, in this case, we crossed 40 and 50 at the same time coming off of that one. Over here, we crossed 40 and almost 60. Got the 59 on that day. So that's the kind of move we want to see and get that momentum line strongly higher so we can feel really good about a bounce up to the upside. So far, it's still not the case for the S&P 500. The NASDAQ is not looking very good either, though its lines are a little bit higher. Again, coming off a cluster, we did not close above yesterday's high, nor above the day before that. We also, again, closed below the open, even though we were 1% higher on the NASDAQ. The market sentiment is actually down into the lower half of the chart, so the S&P is not there yet. The Dow Jones Industrial Average actually fell today. Got a second cluster in a row, so 2 clusters in a row for the Dow Jones. Remember, we had a few in a row over here when we formed a low point. So not necessarily the best sign there. 5.5% below the moving average. If I take a look at the zigzag for the Dow Jones Industrial Average, it's not at 10%, only at 7.87%. So that's not too bad. You can see the low point that formed over here for the Dow when we started the correction in 2022. You notice it didn't even get to 5%. So the Dow doesn't always kind of go all the way down like the S&P does, and that's kind of what we're seeing here. And then finally, let's take a look at the Russell 2000, which remember is the Russell 2000 actually is in a correction. It is not in a pullback. It is in a correction there. And so you can see it bounced up today too, but the smallest gain out of all of them. The short-term sentiment lines are up, but not very high. The near-term line is actually higher than the momentum line. The intermediate line's well in the reversal zone, below the 10th percentile. We are way below the moving average. Dark pink shading a red line. It doesn't look like that's ending soon. Really quickly, I did tweet out earlier today, this idea of here. Let me just. Let's do this. I did tweet out earlier today this kind of my definitions. I had a big long thread here, and it's at the top of in fact, it's right here. To kind of give you an idea, like it's down in fact, you'll see it. I have it quote tweeted there a couple of times. This thread goes through all of the bear market stages, right? All 9 of them. There are 9 stages to a bear market. Right now, we are in stage 1 of a bear market. If we are going into a bear market, we are in stage 1, which is this is the entire bear market right here. So this is where we would be right now if this is ultimately a bear market. I don't think it will be yet, but no one knows, right? No one knows if it is yet, but this is where we'd be right now. So I go through all 9 stages of a bear market and a couple other tweets here at the end to kind of give you an idea on timing a bear market, as well as what happens with pullbacks and corrections. So go through, take a look at that thread, bookmark it so you have it at your disposal, right? So bookmark it and then share it, retweet it, share it with other people. But that's kind of when I say correction, pullbacks, bear markets, that kind of gives you an idea of what I'm talking about right there. It's all laid out in that thread. So check that out there. All right, let's take a look at the weekly chart. So let's take a look here. What's going on a weekly basis. Again, closing below the 40-week moving average. We haven't done that since that last week in October. Before that, it was the early January timeframe. That was the last time. See, we didn't get a death cross in October because we bounced right back up above those lines the very next week. So we did ultimately get a death cross over here in April, though we closed below it initially there that week of January the 24th. Pretty decently sized candle still. And as of right now, again, we're going to close, we're going to open next week's candle at 57.95-ish. And right now we're trading at 55.99, so 200 points down, which is right down here. So it's going to be a pretty decently big body next week too, depending upon how we finish the week, of course, right? The higher we can finish on the week, the higher we can get to that open, by the time we get there. So remember, the Russell 2000 is in correction. So when I say that, in this case, we're actually getting a death cross, right? The 10-week actually is falling below the 40-week. We are well below the 40-week exponential. You can see the size of the candle is pretty sizable. So it is in correction. So it got in this mode about a month before the S&P did last time we had a correction, and it appears to be doing something similar this go around as well. When I take a look at the 3 green arrow charts, obviously we still have 3 red arrows across the board here. Here we go. We still have 3 red arrows across the board, all across the board. There's nothing really close right now to getting a green arrow. The stochastics are all pretty oversold. So obviously, clearly a pullback from that perspective. When you look at the 2-line versions, we're still below the 200-day moving average. 3rd straight day we've closed below the 200-day with a 10% decline from high to low, not necessarily close to close, but from high to low, we have a 10% decline there. MACD, you can see again, is really down there. It's down now almost to 2%, which again is not the kind of drop when we get normal pullbacks, right? We don't get, you maybe get down to 1% and maybe a little bit below it because of that weird August 5th move, but that's not what happens during normal pullbacks, is a MACD that gets down this low here. If I take a look at some of these other oscillators like the DMI, remember we still have a bearish pattern here that, in fact, the negative indicator is extremely low. The ADX is spiking, it's up to 32, so it's almost as high as it was there, but obviously it's lagging, so it's still got some room to run. Remember, and it's also, unlike this one where we came off of a low point just below 20, we were extremely low. So this is a big spike over here when we had the big jump up to about 35 on the ADX. We were already high because we were so bullish and we were coming off of this. So this is an extreme move to the downside that we haven't seen again for just a pullback, right? We don't typically get these kind of moves on just plain old garden variety pullbacks. When you look at the RSI and the CCI, again, they're still below 40 on the RSI. We're still well below 100 on the CCI, and remember it's the weekly CCI that's down to such a low level, down to 250. Again, we'll see what happens by the end of the week. We got 2 more days left, but that would be the lowest CCI close since that January 24th week. So pretty significant. We're almost below 40 on the RSI, which we were that last week in October briefly, but we didn't get below 40 on the weekly RSI until way over here in March of 2022. So a little bit faster move there from that perspective. The Ichimoku cloud still has a mature bearish trend. Again, that doesn't happen during intermediate declines. A garden variety 5% pullbacks. We're still below the cloud, so easily below the cloud, way below the blue and the red lines. The rate of change, here's that rate of change. It's pretty sizable to the downside. You can see, the biggest downward. This is that red line on that Ichimoku cloud. So this is the biggest move to the downside that we've had on that rate of change since, again, early 2022. So we don't typically fall this far during normal pullbacks. We got this far briefly down to 7. Where do we get down to? 7.75% during the regional banking failures that we had in March of 2023. We were on the cusp of that correction and failed bounce turning into a bear market at that point. And again, you go through that thread to see what stage that would be. That would be the move to and through that we avoided thanks to the Fed and a lot of liquidity they pumped into the system in that banking crisis. Well, here we are again down. We got down to 7.5% yesterday on that rate of change. This is again the rate of change I'm referring to, this red line here. So we are pretty significantly below, and unless you can see the price from 26 days ago is rising. So unless we rise to that amount or better, then it's going to stay low or get lower. So pretty bearish move there from that perspective. Again, not what we see during garden variety pullbacks. And then again, our bandwidth is through the moon. Look at that Bollinger bandwidth spiking up above 12. And when it was, remember how it was extremely low? We were talking about a breakout occurring. And then the possibility of that being a high possibility of that being a fake out, that initial bullish move. When we got above the upper band, well, that's played out, right? And now we are again about as high, almost as high as we were at the end of October on that big pullback move there, and which we will get higher because this is very lagging. And then about as high as we got over here on that first pullback move of 2022. So you can see just how significant. Remember, this was at the end of a multi-month deep pullback. Let's see here that we had over here, and it's actually on the rally that we got this high, not the decline. It was the rally, it was the bounce that we got such a big bounce. This is the first time we've been this high on a decline again since early 2022 there. Again, not typical of your garden variety pullbacks. Looking at the week, so this is where it was like, okay, we opened up the day with a really sizable gap. In fact, I tweeted out like, look at this. We got a 2 standard deviation gap to the upside. 1.12%. If we just take off from the open and finish up 2% or higher, then at least close to 2% or higher, then we could really get going here. So that would mean that again from the open right here that we just go and probably get up into this level and close up here, filling in probably a lot of that gap and we'd feel really, really good about life. Well, the only thing I talked about, and I tweeted this out earlier this morning too, was don't fill in the gap, right? Don't fill in that gap. Well, we filled in the gap, right? And ended up kind of sideways, like I said, within the range that we set early this morning, and we didn't really break out of it one way or the other. And we're up a little bit in the after hours, but really not, we're not above last week's low point yet. We're not above yesterday. We didn't get above yesterday's high at all. So that's the kind of stuff we need to see. Remember, there will be a green tag. So, we will bounce up here. Like, I don't know if we'll get to 10% or not. I have a feeling we will get to 10% on this red tag first, like in the next day or two. But I think if we don't have a green tag by March expiration, we'll probably be 1 or 2 days away after expiration. Like, I think it will be fast and it'll be explosive, and we'll get a green tag very quickly. The question will be whether we'll get above those moving averages, 30-day, 50-day moving average, and whether we'll fail, right? Because that's what turns a pullback into a correction, is that pullback bounce fails at resistance after getting a good, sizable move like 5% around, plus or minus a few points. But and so we're not to that stage yet, and I think based on how we open today, it doesn't look like this is day one of an explosive move to the upside. Now tomorrow could be, right, and we'll see if that ends up being the case. But we're also just as likely to close maybe a little bit lower tomorrow and see if we end up getting that 10% tag and a new 4-week low point. Remember, the Arun indicator, if we're gonna really take off and set the low point, that needs to get below 70. Which means we go 6 days without a new low forming, and that's a good thing. And the green line needs to get below 0. So we'll see if that ends up happening here by the end of the week or not. I don't think so now, based on how we finished today. I felt good about that happening at the beginning of the day, at the open, after the CPI. I don't think so now. I think we still have maybe 1 or 2 more days of weakness here. Maybe kind of a rally tomorrow and then more of a close Friday, or vice versa, before we really get that explosive move, most likely at least starting next week, going into March options expiration. If I take a look at the volume and the trading ranges, they continue to be very strong. So you can see the trading range is slightly below the average. Remember, that average now is very high. And the volume is 69 million, again, slightly below that one, still above average, but below what we've seen over the last few days. So that normalized ATR has pulled back a little bit. Still really close to 2% there at 1.8%. So, and you remember, those explosive moves to the upside will actually make this go up, not down, because the first few days of the rally to the upside that we get the green tag, there'll be big days too, right? And then they'll start to taper off as we get above moving averages. But to get back to the moving averages, there'll typically be some pretty strong gains, and right, so some big ranges, which will actually make this go up. Which again, this is pretty high. This is not like we got that high here because of that weird August, but the reality is, if I zoom out here, this is pretty high. Like, we don't get this high during normal pullbacks, right? We get this high when it looks like we might be on the cusp of something more than just a pullback, getting up to that dotted line, which is the 2% area. Finally, we'll take a look at the VIX. And you can see the VIX pulled back today pretty significantly, down 10%. Remember, it never did gain 20%, so it's never been extreme. We are still above 100% though, and we are still above 110 on the VVIX. So we are still susceptible to the type of move where we can still, set a new low with a big volatility move. And I think that's probably what we're going to ultimately get. Whether we end up getting the 20% or not remains to be seen, with a big jump in the VIX, because again, that would probably, now it would get us, 2.5 points. So, it would get us to 29 if we got a 20% move in the VIX now. So, whether that ends up happening or not, but usually that's the kind of move we get. At least, if not at the start, it's usually how we end. Like, you can see, we end all these runs with the big jump in volatility. And I don't think that was necessarily a big jump there. And of course, when you look at volatility relative to its own average values, so all these moving averages, we're still like easily high. We haven't like broken back down hard below like the 17-day or 8-day. I mean, 8 days a step. Getting below the 8 days is a big step, but we have to kind of follow through on that and get below the 17-day as well to be really feeling good about, okay, we're done with this rise in volatility and we're going to at least pull back down to the 200-day. If not, hopefully get back below it and start a bullish trend again up to the upside. All right, now let's take a look at what's driving the price action today, right? So today was the big change. So we'll zoom in here. Yes, gold's been your best performer. Developed market stocks have been doing pretty well too. I'll show you that here in a second as well. But let's take a look here at March 12th. Just today alone. Let's keep it on the 5-minute. Whoops. Try that again. Keep it on the 5-minute chart. So the Qs ended up with the best performance at the open, right? They were up almost 2% at the open. Finishing up with just over 1%, but they had the best performance, big time move up in the sectors that we want to move up. The international stocks doing pretty well as matching the S&P. Small cap stocks did not do as well. There was a time this morning at the lows of the day where we were negative. The S&P was negative too, but the Russell 2000 got almost 0.5%. In fact, the Russell 2000 finished down, only up, about 0.25% there. Commodities were flat. Real estate was down. The dollar was up, but only just a little bit. So pretty minimal moves by the end of the day in most of these asset classes. And then, of course, equities really kind of, roller coaster ride for equities throughout most of the day today. I told you that the international equities have, kind of different performances here. Well, there's your developed markets, right? Well, China's not a developed market, but there's Germany, Italy, France, there's the UK, all developed markets here. Japan, they're all doing pretty well. At worst, light pink shading and a green line, but at best, well above moving averages are rising to the upside. The S&P does not look like that. Canada does not look like that. So both of these two kind of tied at the hip, obviously. Brazil not looking so hot. China looking pretty strong as well. India, on the other hand, not looking so strong, which is a difference for those two. China's been struggling for so long, and India's been doing well. And then Korea, again, kind of similar. It would be kind of a proxy for what's going on in China. Kind of flat, not really moving up or down. It's pretty flat for the past 3 months. So interesting moves there. Of course, the big thing that we kind of watch for is the move in yields and the dollar. They continue to move, as you saw with the dollar. It's not as big as what we've seen in the past, but the dollar is still below the 200-day moving average, still way below these moving averages here. Then we take a look at the 10-year yield. It rebounded up to 4.3%, but still below its 17-day. There might be a change. Now, in the past, rising yields has actually been bearish for equities, but right now they're pretty positively correlated. So, and the same thing with the dollar. They're positively correlated right now with stocks. So we kind of want them to go back up here. And they're looking okay. They're not they're not forming lows. They're not breaking out to new highs either. And of course, that's kind of what we need, right? We would need the FOMC here to start increasing. We need the odds of rate cuts to go back down. Here's the 2-year. Remember, the 2-year is the path, and we had dropped quite a bit a couple of days ago, down to 3.94%, and we rebounded back up to almost 4%, but still that's well below the 4.25% to 4.5% range. If you take a look at the odds, the rate cut odds here, give it a second to load up. There we go. So here in June, right, we're not going to get a cut next week. We're not going to get a cut in May, most likely. It was at 50-50. Now you're at 13% chance of no cut. So we're not going to get a cut in May. June is probably the first time, because they don't like to do cuts during meetings where they don't offer their dot plots, right, their projections. Because then they like to give you, if they're going to start with either a cut or a hike, they want to kind of give you an idea of where they're going with it. That's what the dot plots are for. So, that could really, the current dot plot, which came out in, would be December, would be way outdated by the time they got to May. If they, they would do one here next week too, but it very well could be outdated by the time they got to the May meeting. So they don't want to do that. They want to, when they're starting a cycle of cuts or hikes, they kind of want to give you an idea of where it's going. So they prefer, if they don't have to do an emergency one, they prefer to do one during those meetings. So that's why May is off the table. March is off the table just because they're not going to cut rates next week. May is off the table now. June, like again, it's at 17%. It's pretty close to the lows, but it was actually lower than that. It was in the single digits. It was closer to 90 some odd percent. So it's back down now to like 83. That's still a high number. It needs to come down a lot more if we're going to be bullish into June and beyond, right? That's what we need. We need these. It's not bullish for the Fed to raise rates, right? Or cut rates, excuse me. It's bullish for them to be on the table in the future, but it's not bullish for them to actually need to use them. So right now they're on the table in the future, but we want to, as we get closer to June, we don't want to use them, right? We want to push them out to September and December and just keep pushing them out, keeping them on the table. That's the Fed put, but not actually using the Fed put, and that's what gets that market to go up. So that's kind of what we really need to see. If you take a look at the breadth, again, most of the moves today higher were in the Mag 7 names, which is not surprising because they've been some of the biggest beat up names during this decline. Right? Apple didn't jump up today, but Nvidia was up 6%, Meta was up 2%, Broadcom was up 2%, Netflix almost 3%, AMD up 4%, Tesla up 7%. But you notice like just how bearish all of these are. They're all dark pink shading in a red line, and a lot of these big gains were pretty much coming off of extreme lows. They're not necessarily like trend changing yet. They're not even really big candles either, which is like what you'd like to see when you're coming up off of a low point. So I wouldn't necessarily bank on this yet, right? Unless we can get a big day tomorrow, we'll feel really good about that. But I wouldn't necessarily bank on this changing things around. So that's really what kind of turned the tide. So as a result, the breadth just wasn't as strong. If you take a look at the breadth, it's still pretty negative, still below the minus 35. We're still dropping below zero on the summation index, which again happens during corrections. Whenever we go above and then back below zero without getting above 500 or 1,000 like that. If I take a look at other breadth indicators like we like to look at, I think I told you last night, the number of stocks above the 50-day moving average really plummeted yesterday. Maybe it was earlier. All these days are running into each other now. It was today. The number of stocks above. So yesterday, here, let me zoom in so we can see it. Yesterday, we still weren't down very. Well, I guess we did. We dropped down to 213. Well, we're down to 150 now. Like we went from like stubbornly staying above 200 now to like a big breakdown to the downside. Now you notice that doesn't necessarily mean we're going to bounce back up. We did, but then we got down to new lows. But at least now we're getting to the extreme levels to where we can say, okay, now this is the problem. Like we're also below 200 now on the number of stocks above the 200-day moving average, and that's extreme. And we don't do that during garden variety pullbacks. That's a level we generally reach during corrections, right? During these, when we get into, there's the 2011 correction, there's the 15-16 correction, there's the 2018 correction. Again, my cursor there. There's the COVID correction. There's the 2022 correction. Again, the 2023 kind of a faux correction that it was a mini correction inside of pullback range. Pullback range being the 50 and 200-day moving averages in between those two. So we kind of had a mini correction inside of that range. Remember, corrections don't start until you're below the 200-day moving average. But that's a big, significant drop. Again, we don't drop below 200 during garden variety pullbacks. Even 2018, which was a significant pullback, bordering on correction, we didn't drop below even 250 then. So we don't do this during garden variety pullbacks, and we have done this now. It's a significant drop. Again, now let me zoom in again. You can see the rate of change down here, which is where is it? Oh, it's the PPO. This PPO. So how far away from the 20-day moving average we are? I mean, that's the furthest we've been away from the moving average. The biggest drop below the moving average we've had for a while. You can see we have to go back to, again, early 2022 to get this far below the 20-day moving average, and we saw a few other instances of that, but it starts to pick up when you get into correction mode, right? When you get these kind of drops, and that's a significant drop there. We are well below both those averages, but because of both of them are falling, we're still, we're moving up. We're above 1.25, but we're still not even to like that 1.5% range yet, which is generally where we get to when we have been washing out from a breadth perspective. So another sign that we might have another day or two of selling to get to that washout mode, like a big day of volatility, a big washout day of this move, whatever the case is, to really kind of like set us up for that explosive 5% or more rally up to the 30, 50-day moving averages here. All right, now let's take a look at the sector moves. So I told you before, we got the moves that we wanted to from a sector perspective. XLK is the one that we really want to do well. It rebounded in a big way. You can see the big move up here. I mean, it hasn't completely turned the ship around, but it's better than nothing. And when you look at the Qs relative to IWM, remember the Q, we did very well. Like we rebounded back up here, very, very well here. So that's good, right? We want to see technology lead the way higher. When you look at the sector rotation here, here we go. When you look at that sector rotation, XLK, XLY have been the biggest losers. So not surprising during a day that's not a down day that those will be two of the biggest winners, right? So if I look at March the 12th on a 5-day, there they are, right? Technology, energy did pretty well today too, before pulling back. But technology is a big winner. Staples, which has been a big winner, was a big loser in healthcare. So that's not surprising, right? When you look back to, again, when this all started back on February the 20th. So right here is the first down day that we had. You can see that's the first down day we had. Staples and healthcare were the biggest winners. They dropped. Technology and healthcare or technology and discretionary were our biggest losers. They rallied. That's what happens. We need to see more of that to really solidify the bounce. And today wasn't enough. Today was more of a we are unbelievably oversold in these areas and overbought in these others, and let's resolve that. At least temporarily, let's resolve that. That's what today's move was. And as of right now, it's been nothing more than that. Still not necessarily seeing the signs that this is day one of the explosive 5% move up to the upside. All right, that brings us to our trade idea of the day, which is actually in this discretionary space, and that is Tractor Supply. A lot of those stocks are still struggling. Home Depot, Walmart, right? A lot of retailers really struggling. Tractor Supply still, after getting that big shooting star a couple days ago, big bearish candle yesterday, and following up with a close below a bunch of lows here today. It's extreme short-term sentiment to the downside. The intermediate line breaking back below its market sentiment line, breaking back down into bearish territory there, dark pink shading and a red line. And when you look at the weekly chart here, Tractor Supply, you can see a big old bearish candle, bearish candle there, but it's on the Hakinyashi, it's a transition candle with a red arrow. Those can be pretty bearish, and that's kind of what that's showing. Obviously, we're getting 3 red arrows here on the stock over the last couple of days. Pretty strong bearish momentum too, so it doesn't look like we're going to get a green arrow anytime soon. Big volume on yesterday's 3 red arrow drop. Looking at the 2-line version of this, we are below the 200-day moving average. We're below the point of control now. We're closing it, like I said, below these lows. 8 and 17-day breaking below the 30 and the 200 for that matter. Things are clearly moving to the downside here. Your DMI, which is a little impacted by that big shooting star pattern, its positive indicator still up there because of that, but the negative is really taken off and crossed up above the positive. The ADX set to move higher. The RSI and the CCI, of course, are at bearish levels, as you can see. Both of them down there at bearish levels. Looking at the Ichimoku cloud, we are below the Ichimoku cloud. Still no trend yet, but well below the cloud, and rate of change has turned negative. So those are all bearish breakout patterns. And then finally, looking at the Bollinger Bands, we did not break below the lower band, we did break below the lower band. We did not break below the lower Keltner channel. But the bands are still inside the channel and looking like we're going to break out of those two. So a good move to the downside I want to take advantage of. So let's go to Tractor Supply here. And what we did was we sold, well, at the time it was like the mid-20s delta. We sold the 50, bought the at the money. So it ended up being $2 wide. And position size as we normally do for $500 roughly. So almost a 2-to-1 reward to risk ratio. I've got we've already got some gains as a result of again, we did this before the market closed at 3:30 Eastern time during the Market Outlook live session. We have a lot of flexibility in case it bounces, right? I mean, it's been such a big move the last 2 days. I wouldn't be surprised if it bounces And if it does, I got some time, right? And for it to still stay below moving averages, keep the max gain inside this range of 1 standard deviation, still be able to work it out ultimately in our favor. But so far so good on a good start here in the first half hour of being in this trade. All right, well, that does it for today. You've heard from me now, and I'm going to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. And let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at marketscholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Wednesday night, everybody, and we'll see you all tomorrow.